$5,036. That's where gold closed last week, down from a peak of $5,408 just 7 days earlier. In less than 144 hours, $400 per ounce evaporated from the most sought-after safe haven asset on the planet. And here's what makes this truly stunning. This happened while the Middle East is on fire, while a U.S.-Israel military campaign against Iran is actively underway, while oil prices are spiking, and while the global financial system is sending every distress signal it knows how to send. In a normal world, gold surges during war. In a normal world, gold surges when inflation fears rise. So if this isn't a normal world anymore, and I'm going to show you the evidence that it isn't, then what just happened to gold? And more importantly, what does it tell you about what's coming next? Stay with me for the next 20 minutes, because by the time I'm done, you're going to understand something that most people scrolling their news feeds right now have absolutely no idea is happening beneath the surface of these markets. Let me give you the full picture before we break down why this matters so much. Gold opened March at $5,408 an ounce, a number that a year ago, back in March of 2025, would have seemed completely disconnected from reality. Back then, we were watching gold breach $3,000 for the first time, and people were calling it a bubble. Then October came and it sailed past $4,000. January 2026, it crossed $5,000. And just last Monday, it hit $5,408. A gain of over $2,200 per ounce in 12 months. That's a 43% surge in a single year, according to Fortune's tracking data. The strongest annual gain for gold since the late 1970s. Let me say that again. You have to go back to the disco era, to the Carter administration, to stagflation and the Iranian hostage crisis, to find a year where gold ran harder than it did in 2025. That context is critical to understanding what's happening right now. Because here's the thing. Gold didn't fall from 5,400 because the world got safer. It fell because of something much more specific, much more mechanical, and this is what I want to walk you through carefully, potentially much more temporary than most people realize. According to the CME FedWatch tool, as of this past Thursday, there is a 94.1% probability that the Federal Reserve will make absolutely no change to interest rates at its March 18th meeting. 94%. That's about as close to certainty as financial markets ever get. And money market traders are now pricing in only about 35 basis points of total rate cuts for all of 2026. That's down from 60 basis points being priced in just a couple of weeks ago. That's a massive shift in expectations in a very short time. And gold felt every single basis point of that shift. Now here's where it gets interesting, and this is where I need you to really pay attention. The reason rate cut expectations just got crushed isn't what you might think. Yes, inflation is still above target. Core inflation is running around 3% when the Fed wants it at 2%. But there's a new wrinkle in this story that almost nobody is talking about. The Bureau of Economic Analysis just announced that the PCE inflation report, that's the Fed's single most important inflation gauge, the one they actually use to make decisions, has been rescheduled from March 27th to April 9th. That's nearly 2 weeks of additional delay. Which means when the Fed sits down on March 18th to make its rate decision, it will not have its most critical inflation data in hand. The Fed is essentially flying blind into its next meeting. And EBC Financial Group noted specifically that this means markets will be leaning much more heavily on CPI, PPI, and jobs data this month because the next PCE print simply arrives too late. Think about what that means. The single most important number for gold just got delayed by 13 days, and the Fed has to make a $1 trillion decision without it. Quick pause. If you found this kind of deep analysis useful, if this is the kind of thing you're not getting from your usual news sources, hit subscribe right now. My analytics show that about 3 out of 4 people watching right now aren't subscribed. If this is cutting through the noise for you, that subscription costs you nothing, and it tells me who the serious community is. It also helps the algorithm put this in front of more people who need to see it. Okay, back to the story. So gold dropped because rate cut hopes faded. But why did rate cut hopes fade so dramatically and so suddenly? 2 reasons. First, the February jobs report. It came in at negative 92,000 jobs. You heard that right. The U.S. economy shed 92,000 jobs in February versus a consensus expectation of positive 55,000. That is a miss of 147,000 jobs in a single month. The unemployment rate ticked up to 4.4% from 4.3%. Now here's the paradox that sounds like it should be good for gold but isn't, at least not immediately. When jobs are this weak, normally you'd expect the Fed to cut rates aggressively to stimulate the economy, which would weaken the dollar and push gold higher. But that's not what happened. Instead, the market started worrying that a weakening economy combined with still elevated oil prices from the Middle East conflict equals stagflation, the one scenario where the Fed can't win no matter what it does. And according to FX Street, Deutsche Bank noted that total easing priced in for all of 2026 has now slipped to just 40 basis points, the lowest level of the year. That's the market saying, the Fed is trapped. Now let me show you exactly how trapped the Fed is, because this is the smoking gun of this entire situation. On one side, you have Chicago Fed President Austin Goolsbee saying, and I'm paraphrasing here from Barron's reporting on his speech, that they stopped making progress on inflation last year. At 3% inflation versus a 2% target, that is, in his words, not good enough. On the other side, you have Boston Fed President Susan Collins saying rates are, quote, well-positioned to hold where they are. And then there's the JPMorgan call, the most dramatic and bearish position taken by any major bank. As reported by the Scotsman Guide, JPMorgan no longer expects any rate cuts in 2026 at all. Zero. Their call is that the Fed's next move will actually be a rate hike, a 25 basis point increase, in the third quarter of 2027. Let that land for a second. The largest bank in America is saying not only will rates not go down this year, but they might actually go up next year. Goldman Sachs has pushed its first expected cut all the way to June. Barclays says June and December. Morgan Stanley says June and September. And here's what that means for gold in the short term. Gold is a non-yielding asset. When you hold gold, it pays no interest, no dividend. So the opportunity cost of holding gold is whatever you could earn in interest elsewhere. When rates are high and look like they're staying high, traders dump gold and move money into treasury bills paying over 3.5%. That's exactly what we saw last week. It's not about gold being less valuable. It's about competing yields making gold look less attractive on paper. But, and here's the critical insight, that is a short-term mechanical reaction, not a fundamental change in gold's story. The structural case for gold hasn't just held up, it's gotten stronger. Let me prove that to you with the numbers. The World Gold Council just released its full year 2025 demand data, and the numbers are staggering. Total gold demand exceeded 5,000 tons for the first time in recorded history. 5,000 tons. The previous record was 4,975 tons. Global gold ETFs posted record inflows of $18.7 billion in January 2026 alone, a single month, led by North American and Asian investors, according to the World Gold Council. Physical bar and coin buying hit a 12-year high in Q4 of 2025, and central banks around the world bought 863 tons of gold in 2025. And while that sounds like it's down from the record pace of the prior 3 years, consider this. The 10-year average before 2022 was 473 tons per year. Central banks are buying gold at nearly double their historical average. And here is perhaps the most telling number of all. In the World Gold Council's 2025 Central Bank Survey, a record 43% of respondents said they plan to increase their own gold reserves in the coming year. And here's the kicker. Not a single respondent, 0 out of 73 central banks surveyed, said they plan to decrease their gold holdings. Not one. Now let me connect this to the historical pattern I want to walk you through, because this exact scenario, where gold pulls back sharply right in the middle of a structural bull market, has happened before. 3 distinct times in the modern gold era, and the setup right now matches all 3 almost perfectly. The first time was in 1979. Gold was in the middle of its monster run from $250 to $850 per ounce, the run that started during the Carter era of stagflation and oil shocks. Right in the middle of that run, in the summer of 1979, gold pulled back 18% over about 6 weeks. Every analyst at the time called it the top. They said inflation was being brought under control, the dollar was stabilizing, and gold was done. Within 6 months, gold had not only recovered, but doubled from the pre-pullback price. The catalyst that resumed the rally? A combination of geopolitical shock, the Soviet invasion of Afghanistan in December 1979, and stubborn inflation that refused to die. Sound familiar? The second time was in 2008. Gold had been rising from roughly $300 in 2001 and hit a then record of $1,000 per ounce in March 2008. Then, Lehman Brothers collapsed in September, and gold dropped 25% in 6 weeks. Traders were selling gold to cover margin calls in other markets, exactly the same mechanism we're seeing now with profit-taking amid rate cut repricing. The people who sold at the bottom, at around $730, watched gold triple to over $1,800 over the next 3 years. The third time was 2020. Gold peaked at around $2,100 in August 2020, then pulled back 13% by November as vaccine news boosted risk sentiment and the dollar strengthened. By the following year, it was back at the same level, and by 2025, it was at $5,000. 3 episodes, same pattern. Macro pullback driven by shifting rate expectations or dollar strength, followed by resumption of the underlying structural trend. Here's what makes this current situation genuinely unique compared to those historical examples. In all 3 previous episodes, the pullback happened because the structural case for gold was weakening. In 1979, Volcker actually did eventually crush inflation by raising rates to 20%. In 2008, the financial system stabilized, eventually. In 2020, the pandemic did eventually end. But right now, and I want to be really precise here, there is no sign that the structural case for gold is weakening. The Middle East conflict is escalating, not de-escalating. Iran has reportedly blocked the Strait of Hormuz and struck U.S. military positions. Oil prices are rising, keeping inflation sticky. And the most respected institutional investors on Wall Street are not running from gold. Morgan Stanley's bull case target is $5,700. UBS sees $6,200. Deutsche Bank has a $6,000 target for 2026. And JPMorgan, the same bank saying there are no Fed rate cuts this year, simultaneously maintained its year-end 2026 gold target of $6,300 per ounce. Let that contradiction marinate for a second. JPMorgan says no rate cuts, dollar stays strong, and also says gold hits $6,300 by December. What does that tell you about how they really view gold's fundamental story? Now let me show you the disconnect that I think is the most important thing happening in this market right now. On one level, you have the paper market for gold, futures contracts, ETF shares, derivatives. That market just knocked $400 off the price in a week because of changing interest rate assumptions. On another level, you have the physical market for gold, the actual metal changing hands between central banks, sovereign wealth funds, retail investors buying coins and bars. And those 2 markets are telling very different stories right now. The physical market hasn't blinked. Central bank buying has been consistent for 4 years. Physical ETF inflows hit a record high just last month. And according to the World Gold Council survey, not a single central bank on the planet plans to sell. The paper market is reacting to rate cut headlines. The physical market is reacting to a decades-long restructuring of the global reserve system. Which one do you think has more information about where this is really going? Here's the deeper structural story that almost never gets covered in mainstream financial media, and it's the reason why every single major bank, despite their different short-term views on rates, has a gold price target for end 2026 that is dramatically higher than today's price. The world is quietly, systematically, deliberately reducing its reliance on US dollar-denominated assets as the primary reserve of choice. According to the Brookings Institution, gold now accounts for roughly a quarter of global foreign reserves, primarily because gold's price has risen so dramatically, but also because central banks, particularly in emerging markets, have been net buyers for 4 consecutive years at historically unprecedented levels. And the World Gold Council survey data shows that 73% of central bank reserve managers believe the US dollar's share of global reserves will be moderately or significantly lower 5 years from now, with gold and currencies like the euro and renminbi filling that gap. This isn't a conspiracy. This is documented, published data from the most credible institutions on the planet. Ray Dalio said it clearly at Davos this year. Having a 5 to 15% allocation to gold makes sense, given what he describes as the fragility of the current market structure, where the relationship between fiat currencies and debt as a store of value is fundamentally shifting. Dalio isn't a gold bug. He's a macro thinker looking at the same institutional survey data you and I just walked through. And when he's saying that, and when JPMorgan has a $6,300 target, and when UBS has a $6,200 target, and when Deutsche Bank says $6,000, you have to ask yourself who has better information about where gold is going. The algorithms selling futures contracts because June rate cut odds went from 40% to 35%, or the central banks that collectively bought 863 tons of physical gold last year and plan to buy even more this year. Let me walk you through what actually needs to happen for gold to resume its upward trend, because I want to give you the honest, full picture. not just the bull case, but the actual mechanics. Three things need to fall into place. First, the CPI data coming out on March 11th needs to show at minimum that inflation is not accelerating. If core CPI comes in above expectations, the dollar strengthens further, gold faces more pressure. If it comes in flat or softer, you could see a significant recovery rally. Second, the Fed meeting on March 18th. The statement and Powell's press conference will be just as important as the rate decision itself. If Powell signals even moderate openness to cuts in the second half of the year, that changes the rate picture dramatically. Third, and this is the one that's really being underestimated right now, any escalation in the Middle East that threatens oil supply or global financial stability sends a flood of safe haven demand right back into gold almost immediately. We already saw on March 3rd that gold bounced more than 3.5% in a single session when geopolitical headlines intensified. A market that can move that fast in response to headlines is a market with an enormous amount of underlying buyer interest sitting just below the surface. Now here's the thing that most gold commentary gets wrong. It treats gold as either a rate play or a geopolitical play, as if it can only be one or the other. But right now it's both simultaneously, which creates a situation that's genuinely unusual. When gold drops because of the rate narrative, all the geopolitical buyers who were priced out at 5,400 start looking at 5,036 and seeing value. That creates a natural floor. When gold rises because of geopolitical headlines, the rate traders who sold the futures see momentum they don't want to fight and start covering their shorts. That creates acceleration on the upside. The structure of this market right now is essentially a coiled spring, compressed by two competing narratives, but with one of those narratives, the long-term structural case, much more durable than the other. I also want to address something that I think a lot of people watching this are probably wondering about. Is this drop a sign that the gold bull market is over? Could we see a real correction back to, say, $4,000 or below? So let me give you the honest answer based on the technical and fundamental data. The EBC Financial Group analysis identified $5,160 as the critical support level. Below that on a daily close, the risk of a more significant pullback increases substantially. We tested that level last week and held. The 168-day moving average sits around 5,000, and that has held through every correction this year. According to Light Finance's analysis, the key support for March 9th sits at $4,996, basically the 5,000 psychological floor. As long as gold holds above 5,000 on a closing basis, the technical picture is still decisively bullish. The fundamentals, central bank buying, ETF inflows, geopolitical demand, remain intact. But here's where I want to make this personal and practical, because the whole point of understanding all this data is to figure out what it means for you. Let me give you 5 specific things to watch and one important disclaimer to go with all of them. And the disclaimer first. Nothing I say here is financial advice. I'm not your financial advisor. Every person's situation is different, and any investment decision you make needs to be based on your own research and ideally your own professional advisor. That said, here's what the data suggests you should be paying very close attention to. First, watch the March 11th CPI print like a hawk. If core CPI comes in above 3.2%, gold could retest the $5,000 support level aggressively. If it comes in at or below 3%, you could see a sharp recovery toward 5,200 or higher within days. The market is extremely sensitive to this number right now because, remember, the PCE data has been delayed. CPI is the only major inflation data the Fed will have before its March 18th meeting. Second, the Fed meeting on March 18th. Don't just watch the rate decision. Everyone already knows it's a hold at 94% certainty. Watch Powell's exact language on the second half of the year. If he signals even one cut is still on the table for June or July, that's bullish for gold. If he sounds purely hawkish, inflation not tamed, rates staying higher for longer, that's a headwind. Third, watch the Middle East situation very carefully. The US-Iran conflict isn't over. Iran has repeatedly demonstrated its ability to disrupt oil flows through the Strait of Hormuz. If that strait sees any significant interruption, oil prices spike, global inflation fears reignite, and safe haven demand for gold could push prices back toward 5,200 to 5,400 in a matter of days. Fourth, and this one is for people who are considering physical gold or gold ETFs, understand what you're actually betting on. If you believe the structural story, de-dollarization, central bank accumulation, persistent inflation, and a Fed that is ultimately going to have to cut rates when the economy weakens further, then a pullback from 5,400 to 5,000 and change is not a warning sign, it's a discount. The World Gold Council's 2026 ETF inflow data already showed a record $18.7 billion entering gold-backed funds in January alone, which was before this pullback. If that buying interest was present at 5,400, it's almost certainly stronger at 5,000. Fifth, and perhaps most importantly for medium-term positioning, watch the Powell replacement announcement. Remember, Jerome Powell's term expires in May. President Trump has a short list of replacements, including Fed Governors Christopher Waller and Michelle Bowman, Kevin Warsh, and BlackRock's Rick Rieder. According to Investing News Network, Rieder is reportedly the current frontrunner and would likely be associated with lower interest rate assumptions and more flexible monetary policy. If a dovish Fed chair replacement is announced, and Trump has been explicit that he wants rates dramatically lower, that single announcement could trigger a major repricing in gold almost instantly. Now let me bring this full circle, because I started this video with a specific number, $5,036, and I want to put that number in its proper historical context before we close out. In March of 2025, gold crossed $3,000 for the first time. People called it a bubble. By October, it was at $4,000. In January, it crossed $5,000. By early March, it hit $5,408. And now it's at $5,036, and people are calling it a crash. A $500 pullback from an all-time high on an asset that gained $2,200 in the previous 12 months is not a crash. It's a pause. It's the market catching its breath. It's profit-taking meeting a very specific narrative about interest rates that could shift as soon as the next data print. And here's the historical truth that I want to leave you with. Every single major gold bull market in the last 50 years has had moments that looked exactly like this. The 1979 run had a summer correction that looked like a reversal. The 2000 to 2011 run from $250 to $1,800 had multiple corrections of 15 to 25% that felt permanent in the moment. The 2020 to present run from $1,500 to $5,000 has had at least 4 separate corrections of 10% or more. Every single time, the people who called it a top were wrong, because they were looking at the short-term catalyst for the pullback, a Fed statement here, a dollar spike there, without looking at the structural forces underneath. And the structural forces right now, de-dollarization, central bank buying at twice historical averages, record ETF inflows, persistent inflation, a Fed trapped between fighting inflation and avoiding recession, and a geopolitical environment that's about as volatile as any since World War II, those forces have not gone anywhere. They haven't even weakened. If anything, the delayed PCE data and the geopolitical escalation have made the situation more uncertain, not less. So here's the synthesis. Gold plunged from 5,400 to 5,036, not because gold's story changed. It plunged because rate cut expectations collapsed, from 60 basis points priced in to just 40 in a matter of days, because a terrible jobs report created stagflation fears, because oil prices spiked on Middle East tensions, and because the dollar strengthened. All of that is real. All of that matters. But none of it changes the fact that central banks bought 863 tons of gold last year, that ETF inflows hit an all-time monthly record in January, that not a single central bank on the planet plans to sell, and that every major Wall Street institution has a 2026 price target dramatically higher than where gold trades today. The question isn't whether gold's story is over. The question is whether what we're watching right now is a temporary compression or the beginning of a larger structural reversal. The data says compression. History says compression. The institutional money says compression. The next critical dates are March 11th for CPI, March 13th for the U.S. GDP second estimate plus Michigan 5-year inflation expectations, and March 18th for the Fed decision. Those 3 events in the next 10 days will do more to determine gold's near-term direction than anything else. Watch them closely. Compare the outcomes against what we've walked through today, and ask yourself whether the structural story, the one that's been driving gold from $250 in 2001 to $5,000 today, has actually changed. Because if it hasn't, then the people selling gold futures right now because June rate cut odds went from 40% to 35% are going to look back on this week the same way gold sellers looked back on August 2020 and September 2008 and July 1979. They were watching the shadow and missing the substance. Drop a comment below and tell me, do you think the Fed will cut rates even once in 2026? I want to know where you stand on this because your perspective on that single question shapes everything about how you should be thinking about gold for the rest of this year. I read every single comment. Your real-world thinking helps me figure out what to cover next, and sometimes you all catch something in the data that I've missed. Don't forget to subscribe if you're not already. It's the single best way to make sure you see these breakdowns as soon as they go up. And I'll see you in the next one.